This is Real Estate Rookie episode 346. My name is Ashley Kayer, and I am here with my co-host, Tony J. Robinson.
And welcome to the Real Estate Rookie podcast, where every week, twice a week, we bring you the inspiration, motivation, and stories you need to hear to kickstart your investing journey. And today, we have the one and only Andrew Cushman. If you guys are at all familiar with the Bigger Pockets ecosystem, he's had, I don't know, like 50 episodes on the Real Estate podcast, but it's his first time here on the Rookie Show. And Andrew is an expert in the multifamily space. So we bring him on, and you're going to hear his journey of getting started as a new multifamily investor, what a real estate syndication is, and why he made the transition from flipping houses to real estate syndication. You're going to learn about how to build your buy box for multifamily. We're going to talk about, is now a good time to even get started in multifamily? And you'll be surprised, I think, by what Andrew's answer is.
We recently had AJ Osborne on episode 340, and he talks about why now is a great time to get into self-storage. So I'm very curious as to what Andrew has to say to us as to why now is a great time to get into multifamily.
Now, before we keep going, I just want to give a quick shout out to someone in the Rookie audience by the username of KDimsky79. And KDimsky left a 5-star review on Apple Podcasts and said, "I love this podcast because it gives me the inspiration to pursue my real estate investing dreams. There's a good spread of expert guests, like today's episode, and rookies telling their story." So if you are a part of the Rookie audience and you have not yet left us an honest rating and review, please do, because the more reviews we get, the more folks we can inspire, and inspiring folks helps them take action and hopefully get their first deal, which is what we're all about here at the Rookie Podcast.
Andrew, welcome to the show. Let's jump right into it. Andrew, I want to know, is right now a great time for a rookie investor to get into multifamily?
Contrary to what the news headlines would have you believe, yes, it is. One big thing to keep in mind is if you're looking to get into this, all this negative, crazy stuff that you're hearing about interest rates going up and people can't make the mortgage payments and syndicators are collapsing. All this stuff is happening and it's true, but it only affects deals that were bought in the past. If you are new, if you're looking to get into new deals, all this actually benefits you because prices have come down 20 to 30%. And it's a myth that interest rates make apartments not work. What happens is when interest rates go up, the cost of debt goes up, and therefore the price has to come down in order to be able to have the property generate enough income to pay for the debt. So if you're going into a new deal, all that means is you just buy it at the right price. You go get a loan. Doesn't matter if it's 6, 7, 8%, as long as you bought the property for the right price. And if it cash flows and works today, you're good to go. So all of the turmoil that you're hearing, if you're looking to get into the business, this is the chance you've been waiting for the last 10 years. Because the refrain for the last 10 years is it's so hard to get a deal. It's too hard. There's so much competition. Everyone's overbidding. And that was all true. That is all going away. And now is definitely the time to get in. Because again, competition's way down. Pricing is down 20 to 30%. Seller motivation is up, right? It used to be you had to put like hard money, which means before you even do any due diligence, you can't get your deposit back. So there's a huge risk there. That is going away. And also keep in mind, it is impossible to perfectly time the market. We will only know when the bottom is when we're looking back going, oh, dang, that was it. I wish I bought more. So if you take advantage of the disruption now and pick up the right properties that you can hold long term, nobody has ever regretted buying a nice multifamily property 20 years ago. You cannot find that person. So if you be that person who starts buying now, then you're setting yourself up for success down the road. And again, now is the chance we've been waiting for the last decade.
Andrew, you said that some of the properties that aren't performing well or that are struggling, it was properties that were purchased in the past. What were some of those mistakes that you think those buyers made that set them up to struggle given this current economic climate? And what can we learn from that as new investors?
I'd say there's two main mistakes that buyers of all kinds made, from mom and pop to syndicators to big institutions. And one of them is that people got a little too aggressive with their assumptions. And this kind of addresses a broader topic of when you're looking at deals. of making assumptions that have a high probability of coming true. And so I'll give an example is, I saw deals get sent to me where the person or the group buying it was assuming 7% rent growth for the next 5 years. That's unlikely to happen. Or, property taxes only going up 2% a year for the next 5 years. Again, not likely to happen, especially if you're in places like Texas, where it's a whole game to see how high they can jack up your property taxes. So the number one mistake that has led to current distress was overly optimistic, overly aggressive assumptions in underwriting. The second big one, and this is one where it's a mix of some people were being irresponsible, some people just got caught off guard, and also just the fact that nobody saw a 500 basis point interest rate increase coming. So what happened is something like 70 or 80% of commercial real estate, and including apartments, in 2021 and 22 was purchased with floating rate loans. And if you buy most single family houses, you buy a mortgage, you buy the property, you get a mortgage, the rate's fixed for 30 years, you're good to go. In the commercial world, the debt works quite different. And it's often due in 3 years, 5 years, 7 years, or 10 years. And there's some exceptions, but much shorter timeline. And a lot of the mass majority of the properties in the last couple of years were bought with loans that were due in like 2, 3, or 5 years. So again, that means they're due this year or next year or in 2025. And on top of that, the interest rate moves as the market moves. So someone bought an apartment complex, they might have been paying a 3% interest rate, and today they're paying 8%, which means they can't make the mortgage payment anymore, which means they can't, the lenders might foreclose, or the values come down 30% and they can't refinance into another loan. And so now they have this huge balloon payment that's due in 3 months. They can't refinance. The property's not worth enough to sell. They can't make the mortgage payment. And all of a sudden you've got sellers that have to sell and have motivation. That is something we have not seen in a decade. And that's part of what's leading to both the distress and the opportunity.
Yeah, Andrew, two super incredible points. And I couldn't agree more. And just on that first point about being overly optimistic, and Ash, I want to get your thoughts on this too. But I think for a lot of new investors, it is tricky to walk that line of how aggressive or optimistic should I be when I'm analyzing a deal. Because when the market's hot, like how it was in 2021, 2022, if you were too conservative with your numbers, you would miss out on every single deal. And if you weren't conservative enough, you could end up in a situation where you buy a deal that doesn't necessarily pencil out. So Ash, I want to ask you first, as you were looking at properties 2021, 2022, how were you striking that balance of not being too conservative so that you were missing out on everything, but also not being too lax to where you would potentially buy a bad deal?
Yeah, I'm definitely very conservative when I run my numbers. I definitely don't, say like, oh, maybe I can, get cheaper dumpster service or, for the apartment complex or anything like that. I am very good at being diligent about sticking to my numbers and also like overinflating my expenses a little bit. So what I did to kind of pivot through this change in the market is I found where I could add additional revenue to properties. So one of the things was like, okay, we're buying land. Can we sell any of the timber that's associated with it? What other multiple income streams can we generate? Can we charge people to park their RVs in this huge parking lot? Things like that. So that was where I had to learn, like I have to think outside of the box. As somebody's looking at this property and they're seeing, okay, I can rent this house out for that amount. I can rent the barn out for this amount. What other ways can I generate revenue off of this property where I can now create the income that will make this deal work for me? Where maybe another investor coming in is saying, I can't pay this price because it doesn't make sense, or I can't use this type of lending where I could. So that's where I had to pivot and change, as to finding different ways to generate revenue off of properties.
Yeah, Ash, I really like some of those creative things that you mentioned. And that's, in multifamily, the money is really made in operations, and like some of the things you just mentioned are like those are perfect examples of what makes someone a really good operator versus just an okay operator. In the last 10 years, you could get away with being an okay operator. Now you're going to have to do the things that you were just talking about. And, Tony, you nailed what has been the dilemma for the last 5-6 years is you wanted to be conservative and realistic so that you hit your numbers, you bought a good deal, you were able to pay your investors, all of those things. But if you overdid it, you just never get a deal. And so, if you find the easy, concise answer to that, please let me know, because after we've analyzing literally thousands of deals, I'm not quite sure the answer, but this is what I boil it down to. A phrase that one of my old original mentors told me is, he said, "It is better to regret the deal you didn't do than to regret the deal you did do." And so when it's tough to decide, that's what I lean on.
That is great, Andrew. And I think that's great advice to, any new investor looking forward as to, what they're looking at to buy right now. And as to can I fudge the numbers a little bit? No, you can't to make this deal work.
No, you'll probably regret it later.
Yes. Okay, well, Andrew, this is all great information and just the starting point of what we're going to talk about in today's episode going forward. But first, let's take a short break. So we just heard from Andrew about how past problems that buyers are having are now surfacing in multifamily. Let's get into some kind of consideration is if you want to start multifamily investing, what you should be doing today. So, Andrew, let's kind of start from the beginning. Do you have an example of a deal that you could go through with us where maybe everything did not work out okay and you had some lessons learned?
Yeah, I mean, since we're on the rookie podcast, we'll start with the first one. I wasn't a rookie to real estate. I'd been flipping for 4 years, but I was a rookie to multifamily. And my first, and I did have a mentor and a coach that I had hired. We're actually still friends and business partners to this day. So I wasn't just going at completely winging it. However, people say, well, how did you get that first deal? Well, it was really a combination of enthusiasm and being a little too naive. Our first deal, this was back in 2011 when you could literally just go on LoopNet and pull up a huge list of properties and say, I want to go look at these 10. I'll come out in 3 weeks and they'll still be there. Not the case for the last 10 years, but that's what it was then. And that's how I found the deal. Literally just looked on the map at a market that I thought would be good. Didn't have all the good, the screening procedures that we have in place now. Started talking to a broker that had a ton of listings in that market. He saw a sucker coming from a mile away and said, I'm going to talk to this guy. And I ended up buying a mostly vacant, like 75% vacant, 92 unit, 1960s and 70s construction property out in Macon, Georgia, on the complete opposite side of the country from me. And that was our first deal. I had to raise a total of $1.2 million to get that done. It was not financeable. It had to be all cash. I completely underestimated how hard it would be to raise that money in that environment. And we are kind of getting back to that environment today where everyone's scared of real estate like they were in 2011. And I had to extend the contract period twice by adding more money to the deposit, non-refundable, just days before I had to close, got just enough money raised to close, and then took 6 months after closing to have to finish raising it. Fortunately, our documents allowed us to do that. That is probably the biggest reason why I started turning, my hair really started turning gray about that time, because it was major stress.
Andrew, at least you got some hair. You could join the shaved head club with me.
See, you got a strong presence on the lower side of your head. I have even more gray there, so I'm just like, not gonna work. And so, and some of the mistakes that we made is, number one, well, actually, I'm going to start with some of the things we did right. You said, well, why did you do that on the other side of the country? Well, for one, my philosophy is live where you love to live and invest where the returns are the best. So I live in Southern California. You could not pay me enough to be a landlord here and have to deal with the garbage the legislature makes you go through. So we said, all right, we want to be in the Southeast United States where the economics are good, the demographics are good, it's business friendly, it's landlord friendly, all of these things. And why did we go straight to 92 units, which I don't recommend most people actually do, is because, we said, we want a property that's big enough to hire and support its own full-time staff that works for us, because I'm going to have to asset manage this thing from the other side of the country. I'm not going to be flying out to fix a water heater because, number one, I don't know how to do it anyway. And then two, so I want people who are there all day. They live there. That's their job to run it. So that's why we went big, and we're really glad we did that. Some of the mistakes were dramatically underestimated the cost of the renovations. In addition to those old neglected properties are like a rotten onion. You peel off a layer and the layer underneath is even worse. We had multiple episodes of vandalism where people would rip out the copper pipes, not even turn off the water. Like, they must have gotten soaked. If I was going to vandalize, I'd at least make sure I'm not getting wet. So if the cops see me on the street, it's not obvious who it was me. So they not only did they rip out the copper, they flood the unit. So there goes $50,000. And it was a rough neighborhood. When we walked into the head of the police chief, and we said, "Hey, here's what we want to do. We want to partner with you guys to clean this up." He looked at us and said, "Good luck." That's kind of not the response I was going for. Now, we did get it cleaned up. We did get the crime reduced. When we bought it, it was collecting $8,000 a month on 92 units. We, quintupled that, basically 5 times over, and we did sell it for a good profit. However, lots of mistakes, lots of lessons learned. Don't go buy a giant, neglected, highly distressed property in a bad area for your first deal.
So, Andrew, just one thing I want to question before we get into the nitty gritty of this detail or of this deal is, you said you were flipping for 4 years prior to that. What was the motivation for transitioning from flipping to multifamily?
It was multifaceted. One, flipping is a great way to get started in real estate to generate chunks of money and build up some cash. But unless you're one of these people who is going to build like a 7-figure flipping business and have other people run it, it's just another intense job, and you're only as good as your last flip. You sell a house, you put some money in the bank, you got nothing left to show for it. I mean, again, it's good. It's a good business. It can be great money, but if you're looking for something residual, it doesn't typically provide that. The second is, my wife is my business partner. So when I say we, I'm typically referring to her and I. We had great 2009, 10, 11, great years. Because everyone, again, was scared of real estate. Prices were coming down. We had almost no competition. Well, then everyone else started to figure out the opportunity. And no one had equity anymore. And so we said, all right, flipping's great, but it's just another intense job. What would produce like more residual, more long-lasting wealth? And we said, okay, we just had a huge recession, which probably means we're going to have a long expansion coming after that. Expansion means job creation, household formation. And everybody either got foreclosed on and can't buy a house for the next 7 years, or they know somebody who gets foreclosed on and they're scared to buy a house for the next 7 years. So that means, put those two things, all those things together, there's probably going to be a whole lot of rental demand. So let's go learn how to do apartments. And so that is how and why we transitioned to apartments in 2011.
What about you talked about that you raised money for this deal. So did you do a syndication? Was this private money you took on? Can you kind of explain the funding of this deal?
Yeah, so the funding was, we did a syndication, which, like you mentioned, is basically you put a deal together, you put a pro forma and a package together and say, hey, we're buying this apartment complex. Here's the business plan. Here's what we think the returns are going to be. We need $1 million to do this. Everyone can invest $25,000 or $100,000 or whatever you have. So that's how we funded it. As I mentioned, we ran short because I underestimated how hard it was to raise $1.2 million back then. My very first check was my mom. And then the checks after that were the people who were giving us the money to flip the houses. We had some private lenders that funded those, and then the final $200,000. We didn't want to retrade or go back to the seller and try to change the pricing. So what we did, we said, hey, look, the honest truth is this property has got a lot more work to be done than we anticipated, which is 100% true. We're not going to ask you for a price reduction. However, we want you to help us out by carrying a note and loaning us the remaining balance of the funds. And I think we ended up settling on like $200,000 or $300,000. That's actually how we finished it off, is we got the seller to carry some for us. And then we paid him off when we stabilized it and refinanced it a couple of years down the road.
But Andrew, one of the things you said, which stood out to me, was that you took these relationships that you had with your private money lenders in your flipping business, and they were some of your early investors in this deal. And in the Real Estate Partnerships book, Ashley and I talk about the benefit of starting smaller with your investors, and then testing the waters there to move up to something bigger. So in a flip, I mean, what you're probably holding money maybe 6 months to a year when you've got a flip that you're working on, maybe even shorter time frame than that. So if for whatever reason that partnership doesn't work out, it's a 6-month partnership, right? But since you have built that relationship with people, now is easier to go into a more expensive asset where, you know, the time horizon was, you know, whatever, 3 to 5 years to kind of get that thing stabilized.
And that's another good point. You know, if someone's listening to this saying, well, okay, this is all great, but I don't have any track record. I want to buy a 10 unit, but I have no track record multifamily. Start with the people who know your track record in whatever you are currently doing, whether whether you've been flipping for 5 years and you have private investors, or you've been doing notes, or, you know, maybe you've been working as a pharmacist for the last 10 years and all your coworkers know you as someone who's honest and trustworthy and hardworking. That is, you know, lean on any kind of track record you have in your network there. It doesn't, I mean, every single one of us in multifamily or anything started at zero at some point with no track record. And so, don't let that be a hurdle. Figure out what else do you have that counts as track record, and say, well, you know, yeah, maybe I've never. And again, this only applies if you're raising money. If you have your own cash, this goes away. But if you're looking to bring in other people, leverage the other, you know, characteristics and strengths you have, the other things that you've done to say, yeah, this is something new, but here's why I should be successful at it because of, you know, all this other things that I've done.
And even if you have your own cash, like think about all the big companies, even they've got cash, they're still going out there and raising capital from other people because it allows you to do even bigger deals, right? I'd love to, Andrew, break down the numbers on that first syndication, because I think for a lot of investors, when they hear you had, you know, 92 units, like that's, you know, like what is that, you know, $1.2 million raise, but the pie kind of gets split up quite a few ways when you're doing a syndication, especially the first go round. The syndicators are typically a little bit more generous to the limited partners to make sure that they can get a good return. So if you can, first break down the structure for us, Andrew, on what that deal looked like. And then if you're open, like what was the actual profits that you generated from that deal?
Yeah, so when we closed on it, technically, I was supposed to get a $50,000 acquisition fee. I don't think I actually took that until a year or two later. The split of profits from operations and sale was back then 70% to investors, 30% to sponsor. Today, it's much more common for that to be 80 to investors and 20 to sponsor. You know, when we sold it, what did we sell it? We bought it for $699,000 or something right around there. And we ended up selling it for like 1.92, about 5 years later. I don't remember what the like internal rate of return and all that stuff was. It was, it was good, but I truly do not remember what that was. So again, it was, you know, a lot of mistakes and lessons learned, but that was the buy, the sell, the splits. Like I said, we did refinance about 2 years in, and when we refinanced, we paid off the seller, and then we returned. I don't remember the percentage, but we returned the majority of the original capital to investors. So like if someone had put in $100,000 at the beginning, when we refinanced a couple of years later, they might have gotten like $70,000 back or something like that. But then they still retained their ownership percentage. Like they don't get diluted. And that's still pretty much the structure that we use today, where, you know, maybe we got a Fannie Mae, you know, bank loan. Well, Fannie Mae's government agency kind of, but it's a primary mortgage, and then we syndicate the equity. We put in some ourselves, and profits are generally split 80-20, and we typically operate for about 5 years. And then if there's a refinance in the middle, then we'll typically use that to give some of the original capital back, so that there's less risk, right? If you put in 100 and you get 40 or 50,000 back, but your ownership percentage stays the same. Now your risk level is down because absolute worst case scenario, you can only lose what's still invested. So does that kind of hopefully I do want to differentiate because how things were done and structured 12 years ago is a little different than now, but that's how it was done.
Andrew, I can't even get past the 92 units for 699,000.
Yeah, isn't that crazy? Less than 10,000 a unit. I spend more in renovations these days on a unit than I paid to buy those things.
Yeah, crazy. So what would your recommendation be? So that's how you got your start multifamily funding and putting together a deal that way. What would be your recommendation today as a rookie investor as to how they can fund a smaller multifamily deal?
Recommendations in terms of kind of like the overall process, or just how to get started, or just how to fund it?
How do you think they should start? Say they have no money.
No money. Okay.
How should they go and fund a deal? Should they be looking for bankable products because it's great to get a bank loan right now? Or should they be doing a syndication or try and get seller financing? Whatever advice you have as to this is a great way to try to find a way to fund buying your first multifamily.
So the good news is when it comes to multifamily commercial property, so 5 units and bigger, the debt is not necessarily based on your credit score and your personal cash flow. It's based on the cash flow that the property produces. Yes, they're going to look at your credit score. So if they pull your credit and you're a 321, they're going to say, maybe we don't want to fully trust this person. But you don't have to have stellar credit. It's not like getting a mortgage today where if you're below 750, they don't want to give you a mortgage anymore. You don't have to have perfect credit. So that is the good news. Also, the good news is the money for the down payment, for the renovations, for the transit, all of that does not have to come from you. Now these days we invest in every deal we do, but for a lot of the deals we didn't, because we didn't have the cash. So if you're getting started and you're saying, hey, let's say you live in Dallas and you find a great 10 unit that's a couple of miles from home, you're like, oh man, I really want to acquire this property, but I don't have the money. The ways to overcome that are, number one, you can do joint ventures, which means you and a couple of people who have the money become equal partners in an LLC, and then you purchase the money and you all have decision-making capabilities. This is what keeps it from being a syndication. You don't have to worry about SEC rules as long as you are all, again, it's a JV, you all have management responsibilities. So you are putting in basically the sweat equity, you're finding the deal, maybe you're going to run the deal, and then you bring these people in, they provide the cash. That's one way to do it, joint venture. Another is to, again, syndicate. This is where you are finding the deal, you're going to operate the deal, you put together a pro forma, and you say, okay, I need, 10 units in Dallas, and maybe you're going to go raise $1.5 million, and say you're going to go out to people that you already know, have a relationship with, and say, hey, here's what I'm doing. Here's an opportunity for you to earn some passive income and some wealth creation. Do you want to invest in this opportunity? You're not asking for money. You're providing a service and an opportunity, and it's important to make sure you frame it that way.
That is so key right there. That phrase you just said.
Yeah. Not only do you need to internalize that, but you need to project that when you're talking to investors. And it's 100% true, but a lot of it's just kind of ingrained in our nature. Like, oh, I don't want to ask for money. Well, you're not. You're literally providing a service and an opportunity, especially if you're doing it the right way. So syndication is one, partners is one. You could get private debt. Make sure if you do that, it's for like a large portion. Let's say you need. Let's use some smaller numbers here. Let's just say you need a total of $500,000 and you've got $100,000. Maybe you can get some private debt for $400,000 as long as you disclose that to the lender. Some will allow it, some won't. And then the one thing to keep in mind is, unlike single family, multifamily has much higher transaction costs. You have much larger deposits. You have very expensive attorneys involved going through loan documents and purchase and sale contracts. The appraisals are more expensive. There's a whole host of other things involved that can add up to be 50, $100,000, $200,000, depending on the size of the transaction. Now, if you don't have that cash, that is where you definitely will need to find a partner. So going back to that very first deal in 2011, where we were raising 1.2 million, and again, it was all syndicated, I had to front $125,000 just to get it to closing. Now, that is a cost of the deal, and that is, as the sponsor, if you're syndicating, that is refundable to you out of the raise, because again, it's a cost of the deal. But you have to have that money up front just to get to closing, to make the deposit, to pay the attorneys, all of those things. So if you don't have that, then your first step is going to be is to find somebody who does, and who wants to do this with you. And again, if you're going to go buy a 5 or a 10 unit in your backyard, that amount's going to be smaller. It scales up.
What would you say would approximately be the dollar amount where it's worth it to do a syndication?
That's a really good question. So your first one, in terms of dollars, is not going to be worth it. But you have to look at it differently, in that if you are looking to syndicate apartments, or really any other asset, and build a large portfolio and build a business out of it, making money yourself on your first deal or two is like goal number 4. Goal number 1 is to learn. You can learn a lot through podcasts and coaches and mentors and books, but there's a certain point at which you just got to do it, and learning through guided experience. So number 1, you're looking for experience. Number 2, you're looking to build that track record, so that you can say, hey, I have actually done these type of deals before, because you can get started without a track record, but it does get easier the bigger track record you have. And then, the more you can go to the lenders and say, I have experience, I have other loans, I'm in this market. Those things build on each other. So when you're doing your first deal, and if you're looking to get into syndication, your goals are track record, adding investors to your list, building relationships with brokers, all of those things. Then profiting from it, that's hopefully a nice benefit of doing all those things. You got to really look longer term and realize and understand that the first few years typically of building a syndication business is not all that lucrative. It only gets lucrative. Well, I shouldn't say only. It typically gets lucrative years down the road when you've built it the right way.
So Andrew, one of the things you said earlier that really stood out to me was that you live where you love to live, but you invest where it makes the most sense. And you lived in Southern California, very expensive market, decided to invest in Georgia, a much more affordable place to invest. But how did you decide on what your buy box was as you moved into that market? And for rookie investors today, what would your recommendation be for that first commercial deal on how to build that buy box?
My buy box back then was basically anything that someone would sell to me.
Is that your advice for rookie investors today?
That is my advice to absolutely not do. And candidly, that is one of the reasons that most investors start off in lower end properties, is because they seem affordable. The seller's willing to sell it to you because no one else wants to buy it. And what I like to say is, those properties are cheaper and more available for a good reason, and it's the grass is greener over the septic tank. Just don't step there. Stay away. So our buy box now, or if you're someone who's getting started, number 1, just decide a number of things. Like, are you a cash flow investor, or are you looking for appreciation, or a little bit of both? I would recommend, especially in the beginning, and especially, if you can't take a big financial hit if something goes wrong, make sure you get at least some good cash flow to sustain the property. So you can decide if you're cash flow or appreciation. Are you going to self-manage or use third party? But it just, in general terms, you want to look for properties that are in areas where, now this could be a city on the other side of the country, or this could be just picking the right neighborhood in your backyard. But the key things to success getting started in multifamily is buy in an area where you have population growth, job growth. Those two are the biggest. Beyond that, you want good median incomes or high median incomes. When we say high median income, that means high relative to the rent you are charging. $60,000 median income is pretty good in secondary markets in Georgia. That is the poverty level in Southern California. So you have to basically what you're looking for is can the average or median person easily afford the rent that you're going to charge? You want to buy in areas with low crime. And especially in the beginning, I highly recommend buying properties that are not in flood zones.
Yeah, I had a very bad experience with a single family home in a flood zone. Yeah, worst deal I think I've done so far. But anyway, I want to talk a little bit because you said population growth, job growth, but like where like low crime. As a new investor, where should I go to get this information? Like, what are some tried and true data sources to identify, hey, what's the median household income? Is the population getting bigger or smaller, et cetera?
Yeah, I've got a couple of good sources for you. Number one, we did on, I guess it's the OG Bigger Pockets podcast, episode 571. We went through the whole screening process that we use and how to do that, like how to identify the neighborhoods that I just talked about. So go check that out. And then there was a follow-up episode shortly after that where we dove into some underwriting stuff. So check those two out. However, if you are open to investing, just again, live where you want to live, invest where the returns are good, go to the Harvard Joint Center for Housing Studies. They have an awesome map on that website of every county in the United States, and it's color-coded, which makes it super simple for guys like me who just like it easy and visual. And basically, you want to invest in the counties that are dark blue because that is where you have the greatest population growth and greatest migration. So if you're like, oh, Andrew, I have no idea where I want to start. It's a big country. Go get that map and start with the blue counties. The next thing is some other really good places to get data is we subscribe to Esri, ESRI. I think it's only like $100 or $100 something a year. It's not terribly expensive, but they have a tremendous amount of the demographic data that I'm talking about, like again, population, income, all of that kind of stuff. That is what we use for every deal we're looking at to this day. If you just Google FEMA flood maps, FEMA, that's the government website that shows you the maps of of what's in a flood zone and what is not. You also want to go to the Bureau of Labor and Statistics, BLS.gov. That is a wealth of information for job growth, population growth, income, basically all the government statistics. And then there's another one, it's called Rich Blocks, Poor Blocks. It's exactly what it sounds, just those four words all jammed together.com. And it will show you median income for different neighborhoods. And that's a key point is you'll see a lot of like broker pro formas and offering memorandums where it's like 3-mile radius, median income, $90,000, right? Well, if you've ever been to a city like LA or Dallas, sometimes if you just cross the street, it can be a completely different world. And so you do not want to just take a big average area and say, oh, the median income is good. You really want to drill down to the neighborhood that your property is in. In terms of crime, there's about 1 billion different websites out there like Crime Mapper and a whole bunch. Just Google crime statistics in whatever city you're in, and you'll probably find about 16 different resources for that.
That was great, Andrew. There was a couple there that I hadn't heard of, and I always love to watch Tony vigorously Google things and look things up. But there's two that I would add is brightinvestor.com, and then that's a newer software, and then also Neighborhood Scout too is one that I have used. Yeah,
Neighborhood Scout is good. Also, let's say you've kind of already identified some markets. Let's say you're like, okay, I'm trying to decide between Boise and Dallas and Atlanta. Go to the big brokerage sites like Berkadia is really good, but Berkadia, Marcus and Millichap, Cushman and Wakefield, CBRE, all of these, and sign up to be on their distribution list. Those guys put out reports on sometimes monthly, at least quarterly, about all these different markets. And and they are brokers, so they're a little optimistic at times, but they do typically provide all the sources for the material they're referencing, and so they'll list out all the announcements of new jobs and new plants being built and all that kind of stuff. So that's another really good free resource, is to go get yourself added to the list of the various brokerages that have offices in whatever markets you want to invest in.
That's a great tip right there. That was like a really great informational deep dive into different resources where you can find different stats and data to actually verify the market that you're in. Everyone can go on the Bigger Pockets forums, they can go on Instagram, anywhere, and they can see, what, he's really successful in Houston, Texas right now. You know what? I want to do what he's doing. I'm going to go to Houston because he's doing it. And yes, maybe some investor is successful in a market, but that doesn't mean that their strategy or their why or what their reason is for investing or their end goal is going to align with yours. So just because somebody is investing in one market or location doesn't mean that it is a good fit for what you want to do. So make sure that you are always going and you are verifying. So we could have Andrew right now just tell us, okay, right now, what's the best market to invest in? And Dave Meyer does this all the time, where he'll pick a random market and he will just go through on Bigger Pockets and say, this is the good of this market, this is the bad of this market, this is who should invest there, what not. But that doesn't mean that it's going to be a perfect match for what you're doing. So you always want to go and you want to pull this information on your own. Getting, a market hot tip from somebody is a great starting point. But make sure you're not just taking somebody's word for it and you're actually going and verifying that data from a lot of these resources.
Let's talk a little bit, Andrew, about kind of building out your team. So say that you've chosen your market, you've got an idea of what your buy box is, but as you actually go through the steps of purchasing, setting up, managing, et cetera, I'm assuming you're not doing all this stuff yourself, right? So who are the team members that you need to build out? How does it differ from traditional single family investing? And then what steps are you taking to find those people?
So first off, go get David Green's book, Long Distance Real Estate Investing, even if you're doing it in your backyard, and that will make sense in a moment. The big difference is when you're going from single family to multifamily, there's some additional team members that you need that you may not necessarily need in single family. Team in multifamily, that will often involve property managers. And then, do you self-manage? Do you use third party? That's a personal kind of business decision that depends a lot on what your goals are. My recommendation would be, if you are just getting started and don't have any property management experience at all, either partner with somebody who does or hire third party, but pretend they're not there. And what I mean by that is you are, and you have to have the right third party property company to let you do this, but approach it as they're co-managing with you. And you're there to help them and to make whoever's working on your property their job as easy as possible, so that you can see the systems that they have, so that you can see how they address problems as they come up, and kind of learn on the job. What I don't recommend doing is just, unless you enjoy it and you live right close by and you want to be heavily involved, don't go buy 10 units and try to manage it by yourself with no mentors and no experience. But also don't buy your 10 unit and hand it off to a third property manager and say, hey, send me the report in a month, because that won't work out either. So do something in the middle. So you're going to want to have property management, as again, whether that's going to be you hire an assistant to help you do it or you get somebody third party. You're also going to need contractors. I guess that's probably similar to single family. However, if you're buying 10 units, you're going to need someone who probably has a little more bandwidth than the contractor that can handle one or two houses at a time. So make sure your contractor has the size and the ability to handle bigger jobs. You're going to need attorneys. And that is, now again, if you're syndicating, that's a whole separate attorney. You have basically a syndication attorney.
And they're not cheap.
No, typically they're flat fee, and that flat fee can be anywhere from $10,000 to $30,000 for syndication. And that gets back to the question, at what point is syndication worth it? if you're just doing 10 units, it might not be worth it for the profit unless you're using that as a stepping stone. So, and that's exactly a perfect example of why, because there's boom, 15 grand gone just to get the syndication paperwork done. You're also going to need an attorney to help negotiate and review loan documents and the purchase and sale agreement. I know every state's a little different in single family, but in California, when you buy a single family, it's just title and escrow. We don't involve attorneys. And I know other states, I believe mostly on the East Coast, you got to like sit down and have attorneys all handle everything, if I'm correct. In multifamily, whether you're required to or not, actually one of the biggest mistakes I see some people make is be their own attorney. Do not do that in the multifamily world. You will end up with some nasty clauses in your loan docs that you're not going to find out until way down the road, and you are going to wish you'd spent the money on the attorney. So you want to have a good attorney. You want to have good lenders. And I have actually found it most beneficial to have a really good loan broker, somebody who can take the needs of your property and your finances out and match it to the best loan for your business plan and what you're trying to do. You're going to need a really good insurance broker for the same reason. Insurance, I'm sure most people listening have probably heard that has become a nightmare lately. I've got actually friends who their portfolio, their annual insurance premium last year was $1 million. This year it's $2.3 million. So their expenses went up 130% just on insurance.
Let me guess, was this in Texas?
No, it was actually spread.
Florida?
Yeah, well, partially in Florida and partially several other states. But yeah, you're absolutely right. Florida and Texas are the two, and California are the three main culprits driving the insurance problem. And again, not to scare everybody, the silver lining on that is the free market works. What's happening is insurance premiums are so high now that more carriers are coming back into the business because they can make so much money off premiums, that most of the experts that I talk to now are saying that prices should level out and possibly even start coming down next year, right? So you don't need to underwrite 60% increases every year for the next 5 years. So don't, be careful with it, but don't let that stop you. A good insurance broker. I'm just trying to think. I'm sure I've missed a couple, but those are the key ones. And then the next question is typically, well, okay, that's great, Andrew. How do I find all of these people? Referrals. Go on Bigger Pockets forums and say, hey, I'm trying to buy 10 units in Dallas. Who else has invested in this area? And can you please connect me with your favorite, lender, contractor, syndication attorney, etc. Also, if you're buying a property, I'm going to assume you're probably talking to a broker or agent of some kind. Ask that agent, say, hey, if you were buying this, who would you want to hire to manage it for you? That's how you find that's how I found our property management company that we've partnered with for like 12 years now. Just said, I literally asked the brokers, who would you hire to manage this thing? And the same couple of names kept coming up over and over again. Do that for lenders. Do that for, well, hey, if you were buying this, what contractors would you use? And then when you talk to the lender, say, hey, do you have a favorite attorney that you like to work with? And just kind of do that whole circle of referrals. That is the fastest and most effective way to build a high performing, high quality team of the third party people that you need to do this business.
Another person that is a great resource, and I just kind of recently put this together in the last year, is the code enforcement officer of that town or city. Especially if it's a smaller town, they have more, there's only one code enforcement officer. But anytime, they go and do inspections of multifamily, so they're seeing what operators take care of the building, what property management is taking care of it, what tenants are happy, which ones are dissatisfied, and they've actually become a wealth of knowledge for me as like somebody who's like picking out as to, how well has this property management company.
Yeah, I really like that tip. That's a good one, especially for the, under 50 unit properties. The only thing I would add is if I was asking the code inspector, I would say, hey, I'm considering buying something. And I definitely wouldn't be like, hey, I'm buying this property at this address, because then they're like, oh, cool, let me go look at it.
Okay, so before we wrap up here, Andrew, I want to know one last question. Based on today's current market conditions, Is there anything that you are doing to pivot today that maybe you didn't do last year or the year before?
In some ways, yes. In some ways, no. We've always had very strict criteria of what we do buy and what we don't buy. We've always had, pretty conservative leverage, so we've typically never gone above 75%. But some of the things that we have adjusted are, instead of 75% leverage, now we might be 55 or 65%. So if it's $1 million property, you would be looking at getting a $600,000 loan, which is 60%, instead of 2 years ago, maybe you would have gone for 800,000. So taking lower leverage. Also, we are looking at purchasing, trying to purchase some properties all cash and getting no loan at all. And the reason for that is, yes, it is harder to do because you got to raise that equity, and it's a bigger commitment in a lot of different ways. However, what has changed in the market now is, these days, from a seller's perspective, the most important thing is how certain they can be that you as a buyer will close. And if you can eliminate the risk of your loan blowing up, then that increases surety of close. And so that's going to increase the chance that, number one, you're going to get a better deal from that seller. Two, what that does, it means you don't have any debt service to worry about. Your interest rate's not going to fluctuate. You don't have to worry about paying the mortgage. And then two, you can patiently wait until the market shifts and it's a really good time to refinance, and you do it then. You're not forced to do anything. So we're looking at buying, again, looking at deals all cash. Also, if you're looking at buying a property today, it was really popular the last few years to look at a 2 to 3 year timeline. Don't do that. That business model is on the shelf for now. It would be very risky to say that you have to exit 2 to 3 years from now, because who knows where we're going to be. Have a longer time frame. So typically for us, we've always looked at 5 years. Now we're looking more towards 6, 7, and even 10 years. Because our best guess is the next 2 years might be a little turbulent, and then that is going to set up the next big bull market upcycle, and we want to sell well into that upcycle. So that's a few things as we're looking at lower debt, sometimes no debt, looking at longer hold times, but the fundamentals have not changed.
Andrew, one last question before we let you go here, and it kind of ties into that last point. You said that you're looking at potentially holding properties for up to 10 years. That's a decade. And when I think about our rookie audience, I wonder if they might have challenges getting an investor to commit to a deal for up to 10 years. So if you were a rookie investor, how would you pitch a potential deal with a 10-year hold, given that maybe you don't have that super strong track record yet?
So the investor that funded by far the biggest amount of my flips was a guy in his 70s. And when I brought him that very first apartment syndication that was on a 5-year time frame, he looked at it and said, Andrew, this looks great, but he goes, I'll probably be dead by then. I'm not invested in that. So you're right on. It is definitely tougher to get people to invest for those longer timelines. So, that's, and there's not a silver bullet to it. What I would say is, or how I would address that if I was getting started, is I would build the pro forma and the projection maybe on 5 years, which I do think 5 years is fine. One of the beautiful things about real estate is time typically heals all wounds. Like, the longer you can wait, generally speaking, the better it gets. That's just kind of how the U.S. economy is set up. So what I would do is I would maybe focus on 5 years, but then set it up so that if for some reason in 5 years it is either a bad time to sell, or it's very clear in 5 years that if you keep holding, you'll make a whole lot more money. You have the option to do so, right? So that's actually something that we've been very cognizant to do in our deals the last 3 years. Is they were set up as 5 or 6 year deals, or even 4 year, but we always made sure that the potential is there to hold longer if we either need to or want to. And I'll give a perfect example. We have one in the Florida Panhandle that we bought in 2015. Our pro forma was to sell it in 2020. We still have it, so it's going on 8 years now. But that is because it makes so much money that all of the investors voted. We took a vote because we're doing something different than what we originally said. Voted to keep it. It was a unanimous vote. No, let's keep this thing. And even though it originally was 5 years, so that's how you end up getting a 10-year hold with investors who would otherwise never agree to 10 years. Is you buy it and say, look, our plan is 5 years, but then if you buy it right and operate it right and do such a good job with it, it's not going to be hard to convince people to keep it even longer. And again, and then if your investors are like, no, I really do want to get out, there's different ways to structure that without selling the property. Or hey, you know what? Sell the property, put a check in the win column, and then move that money somewhere else.
And not even with syndications, but that example works with private money too. If you're, amortizing it over 10 years, maybe you do the loan callable instead of that it's actually a balloon payment where they have to give so much notice. Like we've done them where they have to give 8 months notice in writing if they're going to call the loan, or else it extends for, a certain period of time.
That's a perfect example. I have a small property that is not syndicated, and we did that very thing. In order to not have to put quite as much cash into it, we got a number of investors to do private notes. It was a 2-year term. And then we said, hey, at the end of 2 years, the notes just go month to month. One of the investors said, yeah, I actually kind of need my money now. Can you pay my note off? All of the other ones, yeah, we'll just let it keep going. But if we had said, hey, can you give us a 5-year note? That would have been a lot harder, right? But now that they're used to getting an ACH deposit in their account every month, and there's nothing better to do with the money, everyone's like, yeah, we'll keep it. So do a good job, and the problem kind of goes away.
Well, Andrew, thank you so much for this mini masterclass on multifamily. Can you let everyone know where they can reach out to you and find out some more information about you?
Yes, Bigger Pockets forums, of course. Please connect with me on Bigger Pockets. And I am not a social media guy. However, I've decided to slightly catch up with the rest of the world, and I am on LinkedIn now. So if you comment or respond, that actually is me posting and actually responding. So if you want to engage with different topics with me, then please do that on LinkedIn. Our website is vpacq.com, short for Vantage Point Acquisitions. There's a couple of different ways to connect with us there, and I look forward to hopefully talking with you. And for those of you who are only listening to this on audio, go check out the YouTube, because Ashley and Tony are the most color-coordinated hosts I have ever seen on a podcast. They look professional and perfectly match their backgrounds, like both of them. Mine looks like business barf on the wall, and they're like perfectly coordinated. So
well, hopefully they go and they watch this YouTube one, because no other episode will be like that. But Andrew, thank you so much for joining us. You can also find out more information about Andrew and get even deeper into his multifamily deals. You can go to episode 571. It is a great starting point on the real estate podcast, but Andrew is a celebrity there, and you will find more episodes and more information on multifamily. If you would like to learn more about myself or Tony or today's guest, Andrew Cushman, please head to the description of this episode in YouTube or your favorite podcast platform to view the show notes.
Well, Andrew, that was an awesome episode, man. Really, really appreciated that.
Yeah, thank you so much.
Yeah, it was fun talking with you guys. So
it's always cool when we can break down kind of like the meatier, kind of more intimidating, Ricky topics for folks and make it seem more attainable.
Well, hopefully we'll get some value out of that. So
yeah, no, it was super good, man.
I'm Ashley at Wealth from Rentals, and he's Tony at Tony J. Robinson on Instagram, and we will be back with another episode.